Hi, it's Carl Allen. Welcome back to Dealmaker Empire Builder. We're powering through. We're at Module 4, Lesson number 3. And today is all about the business information and the numbers that you need to do further analysis so you can structure a deal in Module number 5 and then make an offer in Module number 6. So first, before the seller or the broker will provide you with any meaningful business information, you'll likely have to sign an NDA, a non-disclosure agreement. If you're running the deal through a broker, the broker will have their own NDA for you to sign. And yes, an NDA is a legal document, but in my opinion, it's not all that significant. It's designed to stop you using the information publicly to harm the business. And I'm all for that. So just skim the NDA, and if you really want to, have your lawyer review it, but I never do. Now, if you've originated the deal directly, the seller may have an NDA. If not, there's a template that you can use and download below. And once you've signed the NDA, here's the information you need. It's also contained in a document that you can download below. And feel free to submit this list of information directly to the seller after the meeting. So let's go through the data. So there are two reasons that we need this data. As always, it's another forward step in the deal and the relationship, and it keeps building that all-important trust, credibility, and rapport. And we also need the data to do 4 key things as a next step. We need to do some basic financial analysis, which you will not believe how easy it is. We also need to assess the basic valuation of the business. Again, it's dead easy if you use the models in Module 5 coming up next. And then having the data will allow us to structure a potential deal. And most importantly, it will tell us quickly how much money we can expect to raise to fund the deal. So pay the seller some cash at closing if he or she wants it or needs it, and pay yourself and/or your contingent fee advisors at closing. And then finally, provide some additional working capital to grow the business, acquire more talent, should the business need it immediately. So we're going to use the data for financial analysis, valuation, and deal structure. And then also, we're going to use the data to do the fundraise if necessary. Now, some of this information is a must-have, like the key financial data. And some of it is a nice-to-have, like the customer list, employee data, etc. So what I'm going to do now is go through each of these items individually, tell you what the information is, and more importantly, why you need it. So first, before we get to the numbers, you want to understand the ownership structure. Now, you're probably going to know some of this already from your basic search work, but you'll want confirmation from the owner as to how the business is legally formed. Is it a sole trader? Is it a partnership or an LLP? Is it a limited company? Is it an LLC, C Corp, S Corp? And does the business have subsidiaries, say previous bolt-ons or acquisitions? And also, is the business that you're looking at owned by a holding company or a topco, as we often refer to it? And next, you need to understand who the key people are, mainly directors and shareholders or members if it's an LLC. And also, you need to understand which directors or members are executive or officers, i.e. they work in the business, versus non-executive directors or members or officers who are external and may go to board meetings and act as part-time independent advisors. So next, probably one of the most important things, we need some numbers. We can't look at any potential deal structures or look at any form of valuation or do any fundraising until we know what the numbers in the business are. So typically, we need the last 3 years of filed or statutory accounts. And what you probably find is the numbers, the accounts, will most probably come from the business's accountant or their CPA. And the reason we need 3 years is because then we'll be able to see the trends in the business, trends on sales revenue, margins, profitability, balance sheet movements like fixed assets, working capital, retained profit, depreciation. And if all these words are foreign to you, you're going to love next week's financial module, module number 5, where we go through the relevant numbers in a lot more detail and give you some tools so you can do this work very, very quickly and easily, or give it to your financial controller in your business or your CPA. And we've got some amazing templates that you or they can download and use as well. Just fill in the blanks and you'll be able to see what's happening financially inside of the business. So more on that next time. But for now, just go and get the data. Now, the filed accounts are going to give you the annual numbers. So we also need some monthly numbers. These are called management accounts. Now, every business will produce these either in Excel or via their accountant or CPA, or usually via software like Sage or QuickBooks or Xero. And when you're trading a business, as most of you will know, you tend to do a month-end process where you wrap up the month's financial activity. You click a button and then Xero, Sage, QuickBooks takes the trial balance, spits out an income statement or a profit and loss, and also a balance sheet for that particular month as well as the year-to-date numbers. So the monthly accounts won't have things in there like the depreciation or the tax that the business will have. That's all done annually by the accountant or the CPA in most cases. But we'll be able to look at the seasonality of the business in terms of sales month on month, and also what the working capital requirements are for the business to operate efficiently during those months. So for example, if you're acquiring a retail business, it may well have a very big spike in sales through Christmas and then drop off in January, February, etc. And if it's, say, a business in a pharmaceutical sector, it may be pretty slow in the terms of sales in the summer months and then spike up in winter when more people get sick more frequently and need medicine. So we need to understand how seasonal the businesses are and how they typically trade month to month. And then we can use this data to build a forecast. So in addition to the monthly management data for the last full trading year, we also want the monthly actual results for this current trading year. So if the business is part way through its financial year when you're looking at it, we want to understand how it's performing year to date since the past full set of numbers. We want to see if the monthly performance is similar to last year or if it's dipped. And what you sometimes see, this is important, is a dip year to year in performance when someone's decided either in his or her mind or formally via a broker or advisor to sell the business. That's because the pressure gets lifted and that trapped, frustrated mindset gets lifted. In other cases, the business performance can spike because they want to dress the business up as much as they can before they sell it. Now, in the latter case, it's not a deal breaker. Far from it in our case. It can actually assist us massively in negotiating the deal, as we know that the business is capable of much better financial performance. And since it's not reflected right now, we can play heavily on that. More on that in future lessons. And what monthly data also tells us when comparing 2 years together is if there's been any big one-off sales. What we ideally want to see is recurring revenue. So if a business did, say, $5 million in sales in 2018 and then $10 million of sales in 2019, yet $5 million of that was a big one-off deal, then we need to know what's going to happen in 2020, because comparing the two sets of numbers will tell us. So it's important to have management's full year forecasts for sales and profit. Are the sales and profits growing? Are they shrinking? And will they give us any narrative as to why that is? What's driving performance up? What's driving it down? Or what are the limitations around the business that might make the numbers flat? A future year forecast is also useful, but I don't tend to over-rely on them, especially from owner managers. The owner may just make up future numbers without any real substance of what's underpinning them. And most of the owners you'll meet will just be ticking over year after year, and they'll tend to set a new year budget in the first few weeks of that current year. The current balance sheet is arguably the most important item that we need from the basic information set, because this is where the money is. We're going to use the assets on the balance sheet to raise financing to do the deal. And we'll also get a sense of the working capital position inside of the business. And looking at this in conjunction with a monthly management account is going to tell us if the owner is extracting any of that working capital by way of cash pre-sale. And again, we're going to get into that in future lessons on financing and deal structuring. Next, we want to understand what charges and debentures exist within the business, also called liens. Hoover's and other online sources that we covered in the deal origination module will tell you anyway, but it's always good to have an updated position from the seller, since it could take a few months for the public databases to update their records, especially if any charges and debentures have been added or removed over the past few weeks and months. Now, a debenture, also called a lien, is just an overarching security blanket that an existing financier will throw over the assets of the business to protect the money that they've either invested or loaned the business to grow. Charges and debentures can impact the valuation of the business, and that's good for us because if someone has a claim over the assets of the business, then that financial charge has got to be deducted from the valuation. This is another way that we can take over a business without potentially spending any cash. Rather than paying some money, taking over those charges does exactly the same thing, and there's no cash impact for us, but it has the same net effect for the seller. And the same goes for personal guarantees. If the seller has personally guaranteed any loans, they can also be taken over by a buyer and used as a great bargaining chip to negotiate the deal. You're also going to need a summary of what the existing debts and liabilities are inside of the business. You'll also see this on the current balance sheet and the monthly management accounts, but I always want to see a quick summary of who any lenders are and can you add them to your funding list, because you can approach them to refinance the debt over a longer period and even top it up in some cases to add to our funding raise to make the closing payment. And in a lot of cases, just taking over the responsibilities for these existing debts and liabilities sometimes can be enough to acquire the business without having to pay any more money. Employee data is also a nice to have, but not a must have at this stage. It's definitely needed for due diligence, not right now. A seller may be pretty nervous providing employee data so early on in the process. If they are, maybe just ask for the details to be anonymized. You want to see the type of people that work in the business, the role that they have, the salary, the benefits, etc. It allows you to understand what skill base the business have and what it may lack once you own it and you've put your own skills into the business and even combined it with the business or businesses that you already have. And you can then go and hire people using the funds that you're going to raise in a couple of weeks to even fill those skill gaps and strengthen the team once you're there. And another good use of the employee information is to scope out potential partners inside of the management team who might also want to buy some of the equity in this business if that's what you want to do, or others that might end up retiring once the owner comes out, what effect that's going to have on the skill base. That's neither a good or bad thing. People generally don't like change. If you buy a business, sometimes people will just retire or leave because there's been a change in ownership. If those people that are in the business, then you don't really want them around anyway if they want to go. You might also find that the employee base could be bloated. There could be too many people in there, and the business could do with a few less heads, which means you'll make more profit if they go. And you're not going to fire those people necessarily because you've positioned yourself as that safe pair of hands. But if people want to leave and the business doesn't need to replace them, then don't. Customer information is also very useful, but it's not critical to have this at this stage. If you get it, you want to ensure that the business isn't totally dependent on like one or two major accounts so that it would put the business in harm's way if you lost one of those customers. Now, ideally, all businesses need a good, wide mix of customers with no one major account being more than 10% of the total sales revenues inside the business. More than 10% could be okay, providing that customer's got a long-term contract and relationship with the business. That's going to give you more time once you take ownership to reduce your reliance on that account. Now, if the seller's nervous about giving you customer data so early in the process, again, you can ask for it to be anonymized. So customer A, customer B, etc. And what's an added bonus to have, if you can get it, is profitability by customer. It's fine having a big customer in terms of sales revenues, but are their margins so low that they're driving the overall profitability of the business down? These big customers may have negotiated for a lower cost per price or per unit, which lowers their value per sale. And finally, it's nice to know the sales mix as it relates to the range of products and or services that the business provides. And you'll typically find that Pareto's principle applies and that 80% of the sales come from 20% of the products. You'll know that from the data provided. And remember, that was one of the questions in the perfect seller meeting, that 30 question sequence. So all this is going to give you a really good, really strong early steer on what your future strategy is going to be in terms of what customers you've got, how you need to change that mix, and also what products and services you have, including which ones are making you money and which ones aren't. So that's it for the basic information requirement. I look forward to seeing you in the next lesson. Until then, bye for now.